Wilcon Depot entered 2026 at full throttle, selling more, carrying less inventory, and fueling a surge in cash flow. Yet beneath these strong numbers, a more nuanced story emerges: growing sales, but shrinking profit margins. Revenue climbed nearly 11% to 18.98 billion pesos for the first half. Net income, however, nudged only 3.5% higher, landing at 1.20 billion pesos. The gap between sales and earnings reveals a central challenge. Customers are buying more, but the mix is less profitable. Gross margin slipped to 37.3%. The share of higher-margin private brands declined, slowing gross profit growth to just 7%. Net margin narrowed to 6.3%, and adjusted EBIT margin fell to 8.2%, signaling that each peso of revenue yields less bottom-line value. Operating cash flow painted a brighter picture, soaring 42% to 4.2 billion pesos. But this gain wasn't fueled by earnings. It came from shedding merchandise inventories. Wilcon cut inventory by 1.43 billion pesos, unlocking cash for new stores, dividends, and lease payments. Inventory management keeps the business nimble, but it's a benefit that can't be repeated forever. Eventually, a leaner stockpile risks limiting product availability as expansion continues. Store growth remains robust. Comparable sales increased 6.6%. New branches contributed 3.9%. The flagship depot network, responsible for over 96% of sales, expanded with 2 Do It Wilcon editions, now totaling 109 stores. Underlying demand looks healthy, yet the decline in high-margin brands means incremental sales generate less profit than before. Expansion comes at a price. Capital spending topped 1.23 billion pesos, ramping up costs for construction, depreciation, outsourced services, and utilities. Lease liabilities climbed to 11.73 billion pesos, with future lease obligations now exceeding 17 billion pesos. These fixed claims on cash flow reduce Wilcon's flexibility as margins tighten. Lease-related expenses are growing, making scale more expensive and earnings quality a focal point for investors. Ultimately, Wilcon's strong liquidity and lack of bank debt offer room to maneuver, but the model is at a crossroads. Sustaining profitability will require stronger returns from new stores and a recovery in high-margin brands. Otherwise, the company may continue selling more, generating cash from lean inventory, but struggling to translate growth into meaningful profit. This is Wilcon's challenge for the rest of 2026. Not just growing bigger, but growing smarter. Investors will be watching, looking for signs that expansion pays off, margin pressures ease, and each peso earned delivers real value.